Silver didn't spike. It didn't surge. It broke the market. December 11th, 2025, 10:42. Trading screens across New York flickered red, then froze. For 7 full minutes, silver transactions were halted without warning. The official explanation? A matching engine synchronization delay. But here's the part nobody wants to say out loud. This is the exact same language exchanges use when the real reason is far more dangerous. The system received more physical delivery demands than the vaults could handle. Think about that for a moment. In the last 90 days alone, according to CME warehouse reports, over 52 million ounces of registered silver vanished from inventories. Not moved, not reclassified, gone, withdrawn, shipped, and no longer available on the open market. And while the public was celebrating new all-time highs, a quiet scramble began behind the scenes. Singapore refiners stopped taking new corporate orders. A London dealer issued its first purchase limit since the 1980s. 2 U.S. solar manufacturers filed emergency requests for alternative sourcing, something they only do when core materials disappear. You're living through the opening seconds of something far bigger than a price rally. You're watching a monetary metal collide with industrial shortages, and when those two forces meet, the world doesn't get volatility. It gets breakage. Here's the paradox nobody expected. Silver is soaring because supply is collapsing, but supply is collapsing because price is soaring. A closed loop, a feedback spiral. The exact pattern that preceded the 1979 explosion, but this time, the numbers are far tighter, far faster, and far more globally interconnected. Bank of America's public target was $100 by 2026. But inside the metals desks, traders are whispering a different phrase. There is no ask, meaning sellers stopped selling. And when liquidity disappears in a commodity the world actually needs, price stops functioning as a signal and starts functioning as a warning. Let me show you the mechanism. This began in early 2024 when industrial demand quietly broke its historical range. Solar manufacturers, electric vehicle producers, and medical-grade electronics consumed 18% more physical silver than the previous year. At the same time, investment demand surged as inflation fears grew. For the first time since records were kept, global demand exceeded mine supply by more than 300 million ounces. Here's the part nobody realized. Silver isn't like gold. Gold is hoarded, stored, and reused. Silver is consumed, literally destroyed inside circuits, panels, compounds, and industrial components that never come back out. Once it's used, it's gone. That's why this crisis feels different. We aren't waiting for hedge funds to move. We aren't waiting for retail speculation. We aren't waiting for central banks to intervene. We're watching the world run out of a material that modern civilization depends on. Now let's talk about the hidden dynamic that pushed this from tight market to full-blown structural failure. Paper silver. On every major exchange, the ratio of paper contracts to physical ounces has remained shockingly high for years. Most investors don't understand what that actually means. When you buy a silver contract, you're not buying metal. You're buying a promise of metal, a claim, an IOU. But when too many people ask to convert that paper into physical bars, the illusion cracks. That's exactly what happened last week. A cluster of institutional investors, rumored to be 2 Asian sovereign funds and a European hedge, requested delivery of nearly 40 million ounces at once. Delivery requests of that size aren't normal. They're not market activity. They're signals of strategic accumulation. And exchanges aren't designed for it. When delivery demand exceeds available inventory, the system's last resort is a halt, a pause, a cooling period. Not to protect investors, but to protect the structure itself. Because if the world sees how little silver is actually available, confidence in paper metals evaporates instantly. And here's the cold mathematical truth. If even 5% of paper claims try to settle in physical metal, silver doesn't hit $100. It doesn't hit $200. It enters a phase economists call functional repricing. That's when a commodity jumps to a level that reflects real-world scarcity rather than speculative trading. Some analysts project $300. Some whisper $500. But the exact number doesn't matter. What matters is this. Every dollar silver climbs destroys paper wealth somewhere else. Because silver isn't just a metal, it's a pressure gauge, a warning signal, a stress fracture indicator for a financial system built on synthetic liquidity and leveraged promises. We're not watching a bull market, we're watching a contract unwind, a reversal of decades of artificial suppression, a reversion to physical reality, a collision between fake supply and real demand. This isn't the beginning of a rally, it's the beginning of the reckoning. And in the next part, I'm going to show you the historical pattern. Every time silver entered this phase, every time supply collapsed, every time industrial demand outpaced mining output, and what the math says about 2026. Because once you see the pattern, you'll understand why this isn't a price story. It's a structural story, and the outcome is already set. Before we talk about $100 silver, You need to understand the one pattern that has never failed in a century of data. Every major silver explosion in history began with the same three signals. Inventories fall, industrial demand spikes, paper markets detach from physical reality. And right now, all three signals are not just flashing, they're burning. Let me show you the historical symmetry, because once you see it, you can't unsee it. In 1979, silver didn't rise because of the Hunt brothers. That's the myth schools teach, but the real trigger was deeper. The United States hit a structural supply deficit for the first time. Electronics demand soared, photography demand peaked, and mine production couldn't keep up. The deficit hit 40 million ounces. Silver went vertical. Now compare that to today. Not 40 million ounces, not 100 million. According to the Silver Institute, the world is facing a global deficit exceeding 250 million ounces, 6 times larger than the crisis that triggered a 435% rally. Think about that for a moment. If a 40 million ounce deficit caused silver to behave like a broken fire hydrant, what do you think a 250 million ounce deficit does? Here's the part nobody realized. The deficit isn't temporary, it's structural. Solar manufacturers are now consuming more than 30% of global supply, a number that doubles roughly every 3 to 4 years. Electric vehicle producers consume another chunk that compounds annually. Medical electronics, military systems, data center hardware, all accelerating. This isn't investment demand. This isn't speculation. This is physical usage that never comes back out of the system. In 2025 alone, over 1.4 billion ounces were consumed, the highest in history, while global mine output barely reached 820 million. The math doesn't match. The gap can't close. And markets know it. You're watching industrial reality collide with financial illusion. And just like the oil crisis of the 1970s, the world has no substitute, no backup metal, no alternative input. Silver isn't optional, it's foundational. Here's where the mechanism tightens. Every time the physical market thins, the paper market expands. Why? Because banks issue synthetic contracts to keep price volatility under control. It's cheaper to print paper silver than to source physical bars, so they print, and print, and print. Right now, depending on the exchange, estimates show 180 to 300 paper ounces exist for every 1 physical ounce registered for delivery. A 300 to 1 leverage ratio, a castle built on receipts, a ledger full of claims with no metal behind them. This already happened before. In 2011, when silver spiked to $49, the COMEX issued 6 emergency margin hikes in 8 days because physical inventories were evaporating too fast. But back then, demand was lower, deficits were smaller, and banks still had supply to dump onto the market. In 2026, they don't. That's the difference that changes everything. Now let's talk about the mathematical trap. The one central banks can't escape. Silver doesn't behave like gold. Gold rises when confidence drops. Silver rises when confidence drops and when industry expands. 2 engines, 2 demand drivers, 1 supply curve that cannot bend. In 2024 and 2025, global mining costs rose sharply due to energy prices, equipment shortages, and declining ore grades. Mining output didn't increase. It plateaued. Meanwhile, industrial usage broke every record. That's the trap. Price must rise to ration limited supply, but the higher price rises, the faster institutional investors pile in. And the faster investors pile in, the more physical metal disappears from the system. A feedback loop, a tightening spiral, a countdown clock no government can slow down. The industry calls it inelastic scarcity. Economists call it superlinear demand compression. I call it what it is, the beginning of forced repricing. And here's the part that should make you pause. Governments know exactly what's happening. They aren't blind. They see the deficits, the refinery backlogs, the shrinking vaults, the geopolitical race for strategic metals. That's why Germany halted industrial silver orders. That's why South Korea signed quiet long-term contracts with Turkish refiners. That's why 3 U.S. defense contractors quietly added silver to their strategic reserves. This isn't fear. This is preparation. And the banks? They're preparing too. J.P. Morgan has accumulated more physical silver than any institution in modern history. Citibank's metals desk increased forward purchases by 22%. China stopped reporting import flows entirely. The same tactic they used before saturating the copper market in 2009. Everyone with real data is bracing for the same event, a break, a fracture. A moment when the spot price disconnects from physical price and paper, contracts implode under their own leverage. That's why $100 silver isn't a prediction. It's a checkpoint, a midpoint, a warning flare on the highway. Because what comes after $100 is the real story. The phase where supply collapses, contracts unwind, and silver forces a revaluation of every major asset class tied to synthetic liquidity. In the next part, I'm going to show you that phase, What happens when paper markets fail? What happens when delivery demands surge? What happens when banks can no longer suppress volatility? And why 2026 might be the year silver becomes the global wrecking ball no one is prepared for. Before you can understand $100 silver, you need to understand what happens at the moment the system breaks. Because the moment of rupture isn't dramatic, it's quiet, it's invisible, and then it hits all at once. Here's how the end game always unfolds. A single institution tries to take delivery, a refinery misses a shipment, a sovereign wealth fund demands allocation instead of a paper claim, and suddenly the math stops working. This already happened before. In 2011, the COMEX nearly ran out of registered silver. In 2020, London vaults reported the lowest available inventory since records began. In 2024, Shanghai premiums surged because physical bars stopped appearing on schedule. Now imagine those stress fractures happening during the largest supply deficit in industrial history. That's the ignition point. Let me show you the mechanism in slow motion. Step 1, liquidity evaporates. Market makers widen spreads. Physical dealers increase wait times. Refineries prioritize governments and defense contractors over retail. The market keeps trading, but volumes dry up. Step 2, the premium disconnect begins. Spot price says one thing, real metal says another. You walk into a dealer and the screen shows $35, but the cashier quotes $52. That gap isn't speculation, it's scarcity. Step 3, institutional panic starts. ETFs delay delivery requests. Banks try to roll contracts instead of settling them. Hedge funds begin scrambling for actual metal, not exposure. And in the shadows, nations quietly stop selling and start hoarding. Step 4, the repricing event. This is where $100 stops being a forecast and starts being an opening bid, not because enthusiasm drives it, but because mathematics forces it. A 250 million ounce deficit cannot be hidden behind paper forever. A 20-year decline in ore grades cannot be solved with optimism. A global energy transition cannot function without the metal that makes every panel, battery, and circuit work. When supply breaks, price resets, not gradually, instantly. Think about that for a moment. When oil hit crisis levels in 1973, it didn't climb, it jumped. When palladium supply collapsed in 2001, it didn't rally, it detonated. When nickel broke the London Metals Exchange in 2022, the market didn't adjust, it shut down. Silver has more industrial dependence than all three combined, and it's sitting on the tightest supply chain of any major industrial metal. That's why the institutions are already positioning, not publicly, not loudly, but quietly, steadily, aggressively. JP Morgan is stacking the largest private silver position ever recorded. China is sweeping global markets without reporting a single ounce. India is drawing down inventories faster than refiners can replenish them. Defense departments across NATO are converting procurement schedules to multi-year silver contracts. These aren't traders. These aren't influencers. These are strategic actors preparing for a world where silver is no longer cheap, no longer abundant, and no longer available on demand. And here's the part nobody realizes. When silver breaks $100, it won't be because of investors. It will be because industry can't function without it. When the supply chain stalls, companies bid higher because their survival depends on it. Solar manufacturers don't negotiate. They pay whatever price keeps the factories open. Battery producers don't bargain. They secure metal or lose market share. Defense contractors don't wait. They buy at any number required. Industrial demand becomes the buyer of last resort, and investors become the accelerant. Now look ahead to 2026, a year when record deficits collide with record electrification, a year when paper leverage is stretched to historic limits, a year when central banks are losing control of inflation, liquidity, and currency stability. This is the environment where silver stops behaving like a commodity and starts behaving like a lifeboat. You're not watching a bull market, you're watching a revaluation. You're watching the moment an industrial metal reveals the true fragility of the financial world built around it. You're watching the mechanism that is repeated across oil, nickel, rare earths, and copper, now arriving in the one metal the modern world cannot replace. Because when silver hits $100, something much bigger is happening underneath the price. Paper wealth is contracting, liquidity is evaporating, and real assets are reclaiming dominance over synthetic markets. And that is why this single move, this one break above $100, won't be the end of the story. It will be the beginning. The opening chapter of a larger correction in how the world values energy, metals, and industrial survival. The dollar can be printed, stocks can be propped up, contracts can be rolled forward, but silver must be mined, refined, shipped, and delivered. And when the world realizes it doesn't have enough, that's when every illusion breaks. The countdown isn't theoretical. It isn't emotional, it isn't speculative, it's structural, it's mathematical, it's already in motion. And the world is about to learn a very old lesson the hard way. When real supply runs out, Price is no longer a number. It's a warning.